Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Friday, July 28th, 2023. In this video, we're going to do in this order. As usual, we'll start out with the equity markets, take a look at the NASDAQ and the S&P 500. Will not be super in-depth there, just going to go over the levels to watch. And also, on a closely related note, talk about the last of the two big tech stocks to report next week, Apple and Amazon. Then we'll roll into an update on the gold, silver, and the euro, and then bring it home with the update on commodities, and that'll be the general commodities tracking ETFs, crude oil, natural gas, and then the two ag commodities are really the one or two I've been focused on lately, wheat and corn. I'll give you updates there. So let's start out with NQ or QQQ, 60-minute chart. We remain above the uptrend line right there. We've been zigzagging around, stair-stepping higher, but still where we were, back in the beginning of the month, and really not much above where we were back in early June. But again, higher. We haven't broken the trend line. Until we break that trend line, there's no powerful or strong sell signal on the markets, just short-term trading. And you'll notice I usually don't post what I did yesterday and I cover in the video. Once in a while I'll do that. I go into active trading mode, and I made a comment to that today. That's why I shared that 5-minute chart with you. We'll get to that one second. Until Apple and Amazon report, we'll probably see more of the same. Yesterday was a big down day, one of the biggest down days we've had in quite some time, and then followed by an up day of almost as much, but I'll get to that one second. And the big takeaway is Apple and Amazon, those two, undoubtedly Apple's the biggest, so that's the single most important company to report, and they're going to report next week. So we'll most likely see more of this, up, down, but I gave you a key level to watch. And I believe this market only goes so far because we've already had several of the big market-leading tech stocks fall flat on their face. So let's just look at the levels, and then we'll review the individual stocks that have yet to report. Here's that 375.40 right there. I highlighted that yesterday in the video, and I got a post out to you in the comment section first for a quick bounce trade off there, and that bounce trade materialized. So that's pretty much nailing the lows. That's where I highlighted there, right there yesterday. Screenshotted that chart, got it out to you in the comment section under the previous post before I did the video. Updated it there, gave you a target, revised that up to 380. Now, you can see, as I always talk about, and I say this often, support is support, and resistance is resistance until unless taken out. Once resistance is taken out, it then becomes support. So what happened today is we gapped up, QQQ, because the futures rose last night, gapped up above that 380 target. That's what it was revised from the video there. And so then that is a breakout above resistance, and so that opens the door to move up to the next resistance level, which as I got out to you this morning, and again, I usually don't post 5-minute charts on front page posts, but this is what I think we're going to continue to see until Apple and Amazon is out of the way. So embrace it, don't embrace it, it's up to you. I'm just going to share where I think the opportunities are because, again, if you're swing trading, yesterday you were here at the close. If you're long, or short, and that's where you were here, and all the way back here. So that's all we've done, guys, really, for the last, in the NASDAQ I'm talking about, is gone up, down, up, down, up, down, and that's probably my best guess what we're going to do until Apple and Amazon are out of the way next week. So all I can tell you with certainty, that's just my guess, is that is resistance there. There's a big old gap right there. That's gap resistance zone. We already got rejected once rallying into that level. Actually, then we came in, tried to test it from below, and here we are. So that was the bounce target I gave you this morning, a revised, next resistance level where we'd probably carry since we took out that 380. And you can see I've drawn some lines here. The indicators, this is wash, rinse, repeat. It's simple stuff. When I say it's simple, I wish I could tell you it's also 100% effective. It's not, but it's very high rate of effectiveness, well over 50%. And that's simply look for these divergent highs, divergent lows, and swing them. Divergent high, divergent low gave you this, really this whole thing gave you this zigzag up, divergent high, correction, divergent low, divergent high, divergent low. And now we're going to have on any equal or marginal new high, meaning from that peak the other day. We're almost there now, but a hair more if you look really, really close. So this effectively gives us divergence once we equal that high, if we equal it all the way up to there. Now, we'll still have divergence a little above. No, actually not much more. So this is where I'd put very good odds at reversing. So let me say this another way. This is an objective level for active traders. If you happen to buy that low yesterday and because we gapped above 380, you're still in it, let's say, book profits, or at least tighten stops up, let it ride if you think we're going a lot higher. Or it's also an objective area to short the NASDAQ 100, to put a short trade on for a swing back down. Where to? Well, the same levels in reverse would act as support on the way down. So 380 would be your first logical swing target, first support level from where we're at right now. That would give you a 1% gain, that which if you actively trade, especially day trading, day traders are, by definition, if you're day trading, you're out at the end of the day. You can then take a oversized position. Let's say your number is 10,000 on a swing trading the Qs. No problem, in my opinion, taking 50,000 or more to try to get that 1%, because you don't have the overnight risk. Overnight risk leads to these gaps that can go for or against your position. And you can see QQQ is a gappy little sucker lately. Why? Because it's earnings, peak earnings week, Fed week, all that other good stuff. And we still have some, not today, but some bigger earnings coming up next week. So that's it. Let's not overanalyze it. Take it, don't take it. Just pointing out the levels that are likely to be the next turn in the market, just like that was the last turn in the market. And this is just short-term stuff right now we're looking at. And then, I do think if we get rejected there based on the technical posture of the 60-minute charts and of the daily charts, this big divergence so far, it's momentum slowing down. That can be evidenced by looking at the weekly PPO or MACD, those momentum indicators. You can see them starting to roll over, but we don't have a trend reversal yet. And again, we won't until that gets taken out. So there's that 375.40. And as I said this morning in that post I got out to you, if and when that level goes 375.40 on QQQ, which was the support to buy yesterday, it's going to take out, there's the comparable support. I don't know if you can see it. I'll read it out to you. That's 15,508 roughly. Let's just call it 15,500 in NQ, the recent lows. Very good support. So if we take it out, we'll have clearly moved out back down below the trend line. Remember, we've had a couple brief pierces below this is the comparable trend line to one I gave you on QQQ. I keep telling you how QQQ comes in a little bit lower the way I have it drawn. There's NQ, the NASDAQ 100 futures, a very significant trend line in my opinion. And these are really just, this is all that post FOMC and big tech earnings noise. You need to break this trend line, obviously, a solid move. And as I like to say, the redder the better. And now, because we have multiple tests of that 15,507 level, that becomes what I like to call, I label this, I call it BOD, or benefit of the doubt support. You can see all the reactions. We got a lot of reactions on that level, even one right there, and most importantly, recent reactions. So if you're going to set a price alert, if you're going to look to add to maybe a swing short position or initiate a swing short position, that's where it's at. So there you have it. Where the downside's most important support level is, in my opinion, right now, near term, of course, and resistance. I just gave you the that gap bounce target zone / resistance on QQQ. This level I gave you the other day when we were right here, and that's where NQ hit. It was resistance in a likely area to cap the rally. And you can see we have 1, 2 distinct reactions followed by a failed breakout. Once that breakout failed, it back tested from below several times and then rejected. Tried to test it again, rejected. So these two levels, again, let me give you the number if you want to trade it or watch it. Right about, give or take where we are, about 15,890, 15,890 on NQ. Those are the important support and resistance levels. So If you're like me, if you're prone or inclined to actively trade, you can recycle and get these 1-2% swings, and you get enough of them, and you're outperforming the market recently. So that's it, guys. So we're at resistance, and let's not forget about the S&P. Even though I'm not trading it recently, I do track it and follow it because that's also a very important index. Mainly because there's a lot of folks trading the S&P 500, and so it was no mere coincidence. You can see this level right here, and that's 4557 right there. That's a comparable level to the support level on NQ, and it's exactly where we hit yesterday at the lows when I posted that bounce trade, to cover shorts and take the long bounce trade on QQQ or NQ. And you can see we have a similar level right here. I'm going to zoom in so you can see it well. To the level I just gave you on NQ. So the levels, to me, the important levels are on SPY about where we are. We've overshot it a hair. We need to reverse right now. By the time this video is over, I'd like to see this 60-minute candle back on or below that 4610. It's not the end of the world because I have the NASDAQ at resistance, and the NASDAQ to me is the more important index right now because it's got those heavier weighting on the market leaders. But either way, that would be roughly 4610, and then bounded by 4557 on the bottom. So this is, let's just call it the range that we're likely to be in until Amazon and Apple report. Now, if we break out, then look, we're going to go up. I will say this now, and I know many probably don't like to hear this. They, I don't. Everyone's different, but it's not going to change the technical posture on the indexes. We've been diverging for a while. Same on NQ. I had the same divergence. And if it's only a marginal new high, now if it's much more than that, much more meaning 5, 8, 10% plus, yeah, this divergence will be gone. Then there's really a very hard case. It's hard to make a bearish case on the 60-minute chart. The case for a decent, double-digit reversal. That gets very, very hard to do when you don't have that divergence on the 60-minute chart, and you get that much closer to the previous highs in the S&P 500 because those highs are going to be like a magnet. Once you get close to them, the MO in this market for many, many years has been every time after a big correction, when you go on and make a new high, you break out above the old highs. I've yet to see this market tear and run from there. It always makes a marginal new high and then drops. However, that marginal new high is going to probably be 3, 4, 5, 6% above the previous high in the S&P, which is on this 60-minute chart going to take us a lot higher. Remember, I'm talking on the daily is where you'd be looking at it. You don't see that previous high here. It goes back too far. So that's where it is. So this is really, we're getting close, but we're not close enough yet. And big earnings coming up. I think we'll have another run back down there. And then again, pretty powerful stuff if that breaks for the reasons I said before. You're going to take out, if this and that comparable level on NQ and QQQ get taken out, those, again, simple, yesterday's lows. They get taken out. They take out the trend line on NQ. They take out the BOD or benefit of the doubt support. And then you have the trend line on NQ just a little bit below that. And if and when that goes, and that gives you a pretty good sell signal to get into some swing shorts that you can hold on to, set a stop, and let them ride for weeks, maybe even months. But unless, I keep saying, got to take out that trend line on NQ and QQQ, and we haven't done it yet. So that keeps me in active trading. That's where I think the better opportunities are right now. And then I'll get into some other things for you right now, meaning other things besides the market. Remember, I'll always cover the markets, whether they're very conducive to swing trading, more conducive to active trading, or even in trading ranges where I don't have a strong opinion. That's just they're the stock markets. We cover that. I always start there, and then I drill down and try to sniff out the best opportunities for individual stocks, individual or different sectors, commodities, things like that. So there's that SPY. I was trying to look at I want to just look at the 60-minute chart. Oh, here it is. So there's the 60-minute chart of SPY. I keep covering the futures, and I know some of you only trade the ETFs. 451.44. You can see how well defined that support is. You can see the divergences. I know on a day you're going up, it feels like it's never going to go down again. But remember, yesterday was our biggest down day in a while. And don't forget, we have old Mr. VIX. I have an alert set there. It has not triggered that buy signal yet, but we have a big old bullish falling wedge on the VIX. Certainly has room to go a little lower if it wants and still keep that wedge and the divergence in place. And so what this will coincide with, most likely, a breakout of this wedge and a rally up here will most likely coincide with, if not immediately, either shortly before or shortly after, a break of those BOD levels, benefit of the doubt levels I gave you on the indexes. All right, one more thing on the markets and we'll move on. Let's talk about the earnings. Okay, let's not forget. So we have right now, I'm going to give the we'll do the check marks for the bears, or we can do it X's for the bulls. Let's just do check marks for the bears. Bears, bears, bears. These three were called down to go down after earnings, and they still are. They dropped immediately following earnings, and they're still well below their earnings peak. So far, when I look at, and these were the big tech stocks, that are both psychologically important to the market, especially these over here, as well as mathematically important to the market. Mathematically meaning they're the top holdings. They make the market go up or down, both the S&P and the NASDAQ. And so down, and not just a little down. They're still well below their pre-earnings highs. Alphabet, not yet. That one, I figured it would pop first, put in the divergent high, which it's done. And if it doesn't reverse soon, then that one I'm wrong on. And Meta too. Meta's up. They need to reverse. By when? Real? Next week. We have Apple and Amazon. These guys are either going to go up after earnings, and again, not immediately when they report, not even at the conference call. It takes a couple days, sometimes a couple days. Sometimes you immediately know if a stock's going to rip or drop, and that initial reaction at earnings does sometimes stick. All I'm trying to say is if you give it at least one full day, maybe a couple trading days, then you minimize getting caught in a whipsaw. I can show you, and I encourage you to do this. Especially Apple has a history of peaking on earnings, and it has a history of quite often popping and running for a few more days after an extended uptrend, and then reversing and putting in not having a correction, but a major trend change. Many times I've seen that over the years. So again, give it a couple days, and just wait. Patience pays. I always say that in the market. So these two coming next week, and we'll just look at the how they look now and how those others look. So I'm going to Q and Q, so I can pull up my components. Just show you that there's Netflix again. Earnings release there, and we're still down over 13%. What was the other ones we had? We had Tesla that same day. Tesla. Beautiful rally right into that major resistance, and it's still down. Even right now, it's still down 11% below its where it closed before earnings. And Apple, well, we know Meta's up. Meta, popped up. Still has a divergent high, but it's back above. Oh no, it's actually. Oh guys, here that was just a minor trend line, a pre-earnings trend line. I'm going to take that away right now because we've traded through it too much. This was and still is the primary uptrend line. Remember, we've kind of got a little sloppy there. We're traded a hair under it, but that was right coming up to earnings. That was the pre-earnings jitter where it sold down. But basically, and again, I haven't modified it. This is that trend line I've had here forever. So if you look at it this way, this is a breakdown and a backtest of that trend line. And again, I know this just from the comment. A lot of you don't want to hear that, and maybe Meta's doing this, maybe the market's doing that. But the day I stop, analyzing charts the way I have for dozens of decades now, is a day I should just give up and find something else to do. So sometimes these divergences don't play out. Sometimes not just divergence. Sometimes the breakdown and a back test doesn't play out for a significant trend reversal. Sometimes extreme overbought conditions, et cetera, don't play out. But right now, again, the case is still there. The case can still be made that this one broke primary trend line support, had initial leg down, post-earnings pop and will soon get rejected. When does that case no longer exist? Well, when it's clearly moved back above that uptrend line there. Okay, so that's it. Breakdown back test on Meta. We'll see what happens from here. Again, ideally in a scenario like this, no matter what the stock is, when you have a breakdown and back test, you can continue to back test for a while, but you're really, the next sell signal, if you will be an impulsive rejection off the back test without recovering, back above the trend line. And the other one was Alphabet, again, marginal new high, big divergence in place still. And then, of course, all right, so there's Apple. Apple, very similar to Meta, very long, super long in the tooth, extended uptrend line, coming off extreme overbought conditions. I've covered this one so many times in the past, but it's just worth reiterating. This is my extreme overbought level, 77.20. You can see, what happened every time it got up to that level. It either got there and it was a one and done, or in most cases you have divergence, negative divergence. So the first extreme overbought reading doesn't do the trick. Then you start to diverge, the indicators come down, make a lower low even on the RSI. That was a one and done tag of the level, and this is it. So we've been diverging. That divergence is getting steeper. So again, may sound like a broken record, but nothing's changed for weeks, if not months now for me. These divergences have only gotten larger, and therefore the ensuing trend change, I believe, will be even larger. And I'm looking for post-earnings a drop of no less than down to 176.15 on Apple. From where we're at today, that'd bring it down at least 10%. Again, that's a minimum target based on the my analysis of the charts. And this one has broken down, but it's all pre-earnings. And I always say, let's take a pre-earnings breakdown or breakout with a grain of salt. I will also say that more often than not always, but more often than not, the technical posture of a chart, if it's clearly bullish or clearly bearish, will dictate where that stock's going to go. Again, not all the time, but most of the time. So far, I'm batting, what is that? Well, we'll see. We get to Google. I was given a little room. On Meta, I'm going to call Meta wrong right now. If it reverses soon, great. But other than that, it's like, if you include Chipotle, then that's 1, 2, 3, I don't know, 4 out of 5 or something like that. And so Apple clearly looks to be headed lower after earnings. We just have to wait till next week. Amazon, same thing, big divergence. It was a very similar technical posture, hit that extreme overbought reading down here. You can see on the RSI, only times it's ever done that right here. And you had, sometimes my lines just disappear. You hit it, and then you had the divergence right there, and then the correction came. That was easily a double-digit drop. Again, you hit it here with a little divergence, big drop. You hit it here, divergence right there. Then the drop came. That was much larger divergence, and another tag of that extreme overbought reading leading into that double top high, and then this followed that one. And now we've come full circle. Since the bear market in Amazon started, or the correction, or whatever you want to call it, back here, this is the first and only time we've come and hit that level again. And just like just about every other time that I've just showed you the last few years, you hit it, and it's not that. We were long here on that one. Then that's where I was getting out. Got out admittedly a little too early. Probably should have just not thought that it would have been a one and done, but it like every other time, it pushed up, and you got the divergence now, just like back here. And so I look at this chart pattern. I know this is a busy looking chart. I just see a big old wedge, bearish rising wedge with negative divergence, and not just that, but also coming off the extreme tag of that extreme overbought reading of on the RSI, that's 78.54. Okay, so anyways, just wanted to update those two and let you know. After that, like I said, these guys report. If they rip up and they take away and undo these divergences and all that, then that's probably going to take the S&P to new highs. But right now, the charts indicate to me that they're going to go down after earnings, and that's going to take the market down with it. So what do we have? Another week? Not even, less than a week. Next Thursday, August the 3rd, both Amazon and Apple, and then that's it. Then Fed's already out of the way, and the Fed was a non-event. It's these guys are going to be the big news next week. Okay, as promised, quick updates on gold, silver, and the euro. So gold, as expected, posted as a long there yesterday off support and my pullback target. If you remember from back here, that was the pullback target, hit up 1%. So, and probably I'm going to give you my thoughts on it. Might want to just let this one ride for now. I'll show you why when I get to the euro in a second. Or, again, if you're in active trading mode, it's kind of like the market's kind of chopping around lately. Nothing wrong. Get 1%, get in, get out. Again, especially if you're an active trader, you use futures, you leverage up, 1%, you do that even once a week. If you make 1% on a trade, that's 4% a month. Multiply that, annualize that out, you're beating the hell out of the market. Even if you miss a few, you're not going to, nobody bats 1,000. But so you can take the quick buck because you're at resistance 182 at 12, or maybe sit tight because remember, we were long here, gold, just as we were short off that divergent high because of the divergence and the breakout. And this is a much smaller divergent high right here compared to that divergent low. So there could be more upside there. I'm just not so sure right now. My convictions aren't strong. They were strong enough yesterday to point that out as a likely bounce. And again, just like with the Qs, but I'm kind of zoomed in on the metals too, as more of a short-term trading mode. We had the Fed and the ECB, so there was a lot of noise lately, but that's over with now. So the currencies and the metals have can choose their own path now without a lot of uncertainty, or a little less uncertainty, let's just say. Silver up 1.13. I always tell you, if you're going to get the call on gold right, go ahead and trade it, but you're just burning up capital. If you're going to get, put it in silver or GDX, you usually get a multiplier or whatever. Gold goes up or down. And as you can see, it's up a little bit more. Not much more today, but silver, again, that's coming off that 2218 support with positive, aka bullish divergence. That's where, recommended either shorting or getting out of longs. And so, you sidestep the pullback. And this is swing trading. And this is more of active swing trading. And I know sometimes when I bullish and long something one day and the next day I'm shorting it, makes some of your head spin. I can't do a one size fits all service here. Some people are, part-timers, and, investors, and ignore all this little 5-minute chart stuff, 15-minute chart, even these 60-minute minor bounces. If that's not your cup of tea, kind of go to the bigger picture. I try to speak to that often and tell you what my views are longer term. Right now, I think there's a little more upside here in silver and gold. And if you did take the long, I still, the other day I said that we could see more downside. My convictions aren't high. Right now, I'm leaning towards a little more upside near term, and let me show you why. It's that euro US dollar. It did reverse yesterday. Remember, this is a 60-minute chart here. We had positive, aka bullish divergence. You can see it right there on the PPO. You can see even larger divergence has been building on the RSI, and there's a reversal. So this was all Fed day here. Then the ECB, they do their rate hike the day after the Fed, and that's that. So you had the divergent high. This said get out of your gold and silver or go short, which we did. This is just swing trading stuff. So right now, bigger picture tells me, here's the the euro US dollar pair on a longer term chart. So there's a couple things. I think I showed this uptrend outline yesterday. We've hit that. So there's a trend line now with enough reactions to validate it. However, we are coming off that big divergent high there. It's been a series of 1, 2, and now 3 divergent highs with even bigger divergence. So that may indicate, or would indicate, a much bigger correction coming. However, how does it play out? How does it unfold? If it does come, we just did hit this support right here. We could bounce. This wedge could get even bigger, or sometimes these things don't play out, and we may take the divergence out. All I can tell you factually is that or with certainty, we just hit that trend line. Now we have validating reaction, meaning we're up today after hitting it yesterday and opening on it today. You have some price support there as well. So really a break of today's lows, a lot like in the NASDAQ 100 where I started the video out, and the S&P 500. That'll probably open the door to another leg down here. And then at that point, you don't want to be long gold and silver. You probably want to be short because of the positive correlation between the euro and gold and silver. Okay, so there it is. Like I said, kind of mixed thoughts on it right now. A little unclear on the intermediate to longer term direction. So I'm kind of just like with the indexes and tech and all that, more in active trading mode than in buy and hold or swing trade mode right now. All right, and then last but not least, give you an update on the commodities, DJP. This is a whole inflation trade. It's been strong lately. As I told you, the markets are going to be in for quite a surprise. I put good money at the next CPI report when they report the July numbers. Here we are. Today's July 28th, and you can see this is the biggest monthly gain. That box shows the beginning of the month. You know, even if we come back down the next day or two, we're still going to have a pretty sizable gain. Again, one of the biggest gains because just pretty much straight up all month. So, and we're seeing that. We're seeing that in interest rates. Remember, the Fed does not control or set the rates on Treasury bonds. Those are set by market forces, supply and demand. The Fed sets the federal funds rate, which is an overnight lending rate, literally a overnight, 1 day, 24-hour period interest rate. But it does permeate, it does control the shorter end of the yield curve, or at least has a big impact on the shorter end. Longer end of the yield curve is going to be market participants. That's you, me, more so institutions who are the big bond buyers, pension funds, foreign governments, Japan, China, you name it, holding U.S. Treasury bonds. That's what sets the long-term rates, and those rates are set by where a couple, various factors and forces, supply and demand, how many bond issuance, but also where they think both the inflation and the economy are going, because those are usually hand in hand. Strong economic growth tends to lead to higher interest rates, higher inflation. Lower growth or contraction, i.e. recession, will tend to lead to lower rates. But the Fed has turned the bond market upside down, made it all wonky with so much excessive intervention in recent years. But with that being said, as I mentioned to you yesterday in that last post, that's a pretty big level. Look, this is the yield on the 30-year bond. Boom, 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 boom. Now, as I like to say, resistance is resistance unless taken out. But if that is taken out, and if it's taken out and it's not always so black and white or binary, 1 day breakout means we're going to the moon. The farther we get away from that, I can all but guarantee this. There's no guarantees in this game of trading and investing, but as close as I can give you a guarantee is that if this happens, the stock market's going to do that. It is not going to like this. I made a comment in that video yesterday, and I tried to add to my notes, some written comments that I posted. I've read what makes sense fundamentally. What I've been reading is most corporations, as well as the majority, a lot more individuals than in the past, locked in, and they didn't lock in. I mean, in my case and others, were locked into 30-year mortgages, at 2.5%, 3%, 3.5%. But most business, a lot of that debt I talked about that is locked in instead of being variable rate. A lot of it's coming due. I think I heard this year alone, of 1.5 trillion coming due in corporate debt that'll need to be, that's commercial debt, I believe. And then another 1.5 trillion. Again, those numbers may be off. I was reading something on that recently, but it's a lot. And so in other words, that whole lag effect from the Fed, it would make sense that it's taking longer this time for higher rates to permeate. So the risk here is the Fed's not seeing the results that they normally see by raising rates. But when all these loans, corporate loans, car loans for individuals, even people that are forced to sell, whether it's death, moving, financial distress, job market, it's all intertwined. You're going to start to see if they have to renew at these rates are higher, it's going to be next to catastrophic for the market. However, so, just to say, there is a glass half full scenario, and that would be the rates go down. We're at resistance, we get rejected. Here's an uptrend line. If you can see long-term rates fall, that's the 30-year. Really, if you're going to watch one bond, really watch the 10-year. That's believe it or not, 30-year mortgages actually track better to the 10-year, I've always heard, than the 30-year bond. But there it is. Again, pretty important levels. And look, if you pop that, that's 4.08%, 4.09% right there. You're just within spitting distance of the multi-year highs. And again, that's not going to be good for the economy of the stock market. Now, on the flip side, for those bullish, and there's an uptrend line if taken out. That's going to be bullish. You're going to see lower rates. That should be bullish for the stock market. But I have to put "should" in big quotations, because one thing that can cause that would be a big move down in the stock market, spike up in unemployment, and other things that cause the Fed to start cutting rates, and therefore bond buyers to believe that inflation is going to go down and economic growth will go down, and so interest rates will go down. So I don't mean to be confusing, but there are forces that can cause this that may be bullish for the market. Again, if the rates drop and the job market holds up, the consumer holds up, the stock market holds up, that's going to be net bullish. But if this goes down because of problems in the financial system, that's not going to be bullish. Okay, but either way, I'm giving you levels to watch, and that would be, again, something that will be a net negative for the market. And again, I don't know if it'll be immediate. I can just say the higher we get above these previous highs in the Treasury bond yields, especially the 10 and 30 years, the bigger the impact that's going to be. And you could see a flashpoint. I think you would see a flashpoint. And the thing is, we're not that far. We're pushing right there. We're close to making here. Let me go back and just tell you how far it's been. If we take out this high, this recent high from 2022 in the 10-year, we're going back to where we were before the last financial crisis. This was the end of the last real bull market, beginning of the last real bear market, where the NASDAQ and the S&P fell over 55% right there. That's where it would take us back to. And you might say, oh, okay, well, that's normal, back to normal rates. Not when we're coming off such an extended period of low rates. The economy just could not absorb that. If it does, and everything I've ever learned about economics and the financial markets, it's just out the window, and you might as well don't bother sending your kids or grandkids to business school anymore. There's no point in learning about basic economics 101. That would just be, again, to me, catastrophic to see this move in rates. And the funny thing is, I don't hear anybody talking about it. All the experts I hear, they just talk about how rates have peaked, and they're, bonds are a good time to buy. Bonds can only go, are going to go up from here. Rates are only going to go down. And so, if no other reason, if we start to see rates go up substantially from here, it's, I think, going to be catastrophic, because nobody's expecting it. Nobody's talking about it. And for that reason alone, it means that institutional investors, individual investors, they're not hedged for it. They're not prepared for it. All right, guys, long rant, and that is longer term macro analysis, talking about what may happen in the economy, what may happen in the stock market, although I'm tying it in with very near term levels to watch, because that could, we're so close. Again, we're in what I call spitting distance of that level of those possible breakouts, and even from those previous all-time or multi-year, multi-decade highs right there, that I think this is an area to really watch closely right now. And because of that, I know I'm not the only one watching it. I have to believe that again, you start to see rates continue to tick up here on the 10-year and 30-year. I would be amazed to see the stock market not respond to it pretty quickly. That's my take. All right, back to commodities. So DJP, commodities, ETF. Told you hot commodities from a technical perspective. It's in a near-term uptrend, clearly making so far just a near-term, the intermediate, the longest term trend, the primary trend remains bullish. That's off these lows. We started a new bull market there. That's the intermediate term trend, which I view as a correction. And this has the makings to be, it's certainly a near-term trend's bullish. And near-term trends have the potential to morph into an intermediate and even a longer-term trend. Okay, so that's where we're at. What do you want to see? The stock market should want to see us fall back here and especially take out that previous low. Unless that happens, there is still risk that we're going to see more rate cuts from the Fed with inflation ramping up. And again, that's just one that I've been using as a tracking vehicle for commodities. If you don't like ETNs, you can use DBC. It's the same thing really, but an ETF tracks the same basket of commodities. And also showing you, there's actually a nice resistance level here. So we're really at a level where if we pop up much higher in commodities as well, both bonds and commodities, that's a pretty nice resistance level, about 2460. Then this is also going to start moving that worry needle for inflation in the Fed and all that. And again, it's what I think will happen, whether it happens right away or not. We could pull back here, certainly, because we're at resistance, maybe back test and then go on. But this big divergence here tells me, and it's what I've been expecting all along, that this has been a corrective wave in an ongoing, pretty early and young new bull market in commodities. And once it starts moving up here, that view will start to become more and more, or clearer to more and more people. And more importantly, the people that matter, the institutional investors. It hasn't happened yet. It's something that I'm watching for. It's something that I expect, but we'll just have to see, exactly how it plays out, whether it moves up now or moves up later or comes down here and does that. And if it does the opposite, then my views on commodities are wrong, and my views on inflation and most likely on longer term interest rates are probably going to prove to be wrong, and that's bullish for the stock market, or at least a net bullish thing. We could have a collapsing stock market crash, and it could crash the demand for commodities too. If the market crashes, let's say we do go down another 50-60%, well, you're not going to be building many new houses and commercial properties and automobiles and planes and trains and all that good stuff. So you could see that. So when I try to put a caveat in all this. There is, net that should be bullish, assuming it's not due to a crash, a demand crash, but it could be. So I'll address it at the time if and when that happens. Okay, crude oil, biggest component of the inflation commodity index, and there it is. It's still pushing that level. I've covered this many times. So just like these broad-based commodity ETFs, if crude breaks out and runs, that's going to be a net negative for the stock market and the economy. And if it gets rejected here at resistance and starts moving down, well, it's got a pretty big range we've been in. There's range 1. This is a larger, bigger, more recent range. That's going to be a net bullish impact for the markets, and it could happen. You've got some divergence forming here. It's just like the divergence I pointed out in wheat the other day, and that's playing out so far. So we need to power through a crude to get much higher. Is going to have to power through that divergence. So we'll watch that. It's again something to watch. All I can tell you is TA 101 says you don't go long at resistance. If anything, you sell your longs at resistance, or you wait for a breakout above that resistance to go long. So I don't see a play right now in crude oil or the broad-based commodities ETF unless we break out there. Wheat, okay, remember last couple updates, we already hit this T2 here, T1, T2. I still maintain these targets, but when we got there, I did point out recently as we're coming up to it, I said, look, we've got to get above. It used to be this level. T2 was at 726, but we pierced above it a little bit in an overshoot. So as we're coming up there, I said, well, it's not 726 we have to take out anymore. It's that previous reaction high, because that's going to be resistance. Traders always look at those previous highs, and it's the problem is, I said, if we hit it or take it out marginally, you got to look at this. We have some negative divergence forming here on the indicators. Now, again, we're coming off a much bigger positive divergence or divergent low, and so my guess is that divergence has already started to play out for a little bit of a pullback. Could come back even some more because that's daily. It shows through all the way on the daily chart. I also showed it to you on the 60-minute chart. This is what it looked like, T4 was hit. And so that put the new line right there. And when we hit it, you can see on the 60, here's our divergence. It actually carries through. This is the daily divergence I just showed you here. So that's it. So that's putting some pressure. You're seeing profit taken on wheat. But if you take away all the lines, what you have here so far is the early makings of an uptrend. Now what we need to do is remain above this low. I suspect we will. And the reason is whether we go down a little more first or not, again, this was a big old bullish falling wedge in, just like almost all commodities, what appears to me to be a new bull market. Wheat, like every other commodity, peaked back, or most of them, it goes back here to 2008. That's when just about all commodities peaked. They were in a vicious bear market since. That bear market bottomed when the stock market did, when COVID hit. And then this has all the makings of a new uptrend. And so I still view this as a first wave up in a new bull market with more to come. And so that's why I'm looking to buy these pullbacks and get in off these divergent lows. And that's why I think these negative divergences, instead of playing out for a move down to new lows and beyond, which is possible, but I think they'll be bought up pretty quickly. And so I still maintain these targets. I just don't have strong near-term convictions because we're coming off that low, and I don't see great support either here or on ZW wheat futures. So kind of tell you, you look this way, you can see some support here. You could certainly be adding back, especially if you took profits and you've been gaming these. We shorted it here when it hit the T2 the first time, and then, and then this was a re-entry point here, as was there. But I recommended a tight stop if you took it there. That was before I went on vacation, came back from vacation, said, all right, now we're back testing. Now it's an objective long, and especially once we started moving away from there. So that's it. Kind of a blurry near term, but intermediate to longer term, I'm still bullish. It's just a matter of, are we going to do this or are we going to do this? Corn, CORN, ETN for corn. Same exact thing. Corn and wheat, birds of a feather. Big positive divergence coming off that low. Divergence there. Big pop. Another run up. We hit this trend line right here. So that was a false breakout so far. And just like wheat, the charts look almost identical. You're coming off, you had a divergent low here on the 60-minute chart, nice big rally, put in another divergent low, another rally, but just like wheat, we recently put in a small divergent high. Now corn's come back to support. So I can tell you right now, it was a really small divergent high. We've had a correction. We're at 23.69, pretty good support. This is an objective long entry for corn. And I think corn might outperform wheat now on the next leg up is my suspicion. And so there's an objective long entry right there. And if you want to keep it tight, not a bad idea. Keep some stops not too far below it. And swing target would be, well, we've already, I would say we'd take out that peak and have another leg up. So you're looking, minimal downside, few, 3-4% stop loss. I think the next target I'm going to give you is right here, about 27.66. I'll mark it in a second. 27.70. That'd be about a 16, almost 17% gain. Yeah, so that's my next target. I'll just put we'll just put T1 right now. Okay, long video. And give me feedback. If you want me to break them up from now on and only do the equity markets and keep that at 15, 20 minutes and then do the other sections, smaller videos, let me know. I kind of like getting it all out there, what I'm watching and these are the things I'm trading and watching lately. Not all inclusive, but a lot, the core things. And but if you want me to break them down into smaller videos, I don't mind doing that. Just give me something in the feedback section. In the comments section, and I'll take that under advisement. Okay, this has been Randy Finney with Right Side of the Chart. Tweaking this trend line. I'm going to leave it there. All right, we'll wrap the video up and see if I can find some other trade ideas for you.